Most people don't even realize this is possible. You can buy an established, profitable business that already has customers, revenue, and employees, and put down right around 10% of the price. The loan that makes that happen is the SBA 7A. And it's one of the most powerful wealth building tools in this country. But there's a catch, and it's the reason I'm making this video. The rules changed in 2025, and a lot of the advice still floating around online around acquisition loans is flat out wrong. People are quoting a playbook that doesn't exist anymore. So today, I'm gonna show you how buying a business with an SBA loan really works in 2026. The real down payment, what the lender looks at first, and the mistakes that can get these deals killed. I'm Siegel, founder of Small Biz Heroes, and I've helped business owners secure well over $80 million in funding. And of everything I do, helping somebody buy a business with an SBA loan might be the most life-changing program that we offer, because you're not starting from zero. You're buying cash flow that already exists. Think about who this is for. Maybe you've spent years as an employee and you want to buy out the owner who's retiring. Maybe you want to buy a competitor and fold them into what you've already got. Maybe you're a first-time business buyer who'd rather buy a proven business than roll the dice on a startup. And a lot of people miss this one. The same loan works for a partner buyout as well. And in 2026, with the policy change that just raised how much you can borrow, the opportunity is bigger than it's been in years. Let me walk you through how it really works. Let's start with the money, because this is where almost all the bad information lives. For a full change of ownership, the SBA requires a minimum equity injection of 10% of the total project or acquisition cost. And the total acquisition cost isn't just the sticker price. It's the purchase price plus things like closing costs and any working capital built into the deal. So the loan can cover roughly 90%, and you need to bring at least 10% in 2026. Now here's a detail most people won't tell you, and it'll save you a bunch of headaches. Banks that do business acquisition loans in 2026 don't just want to see the 10% down. They would like to see another 10% in liquidity sitting behind it as well, because they don't want you draining the last dollar you got into the down payment. They want to know that if the business hits a slow stretch right after you take over, you've got a cushion to keep it running. So the real number to plan around isn't just 10% down. It's closer to 10% down and 10% liquid. If you're a buyer with that sort of qualification for an acquisition price, walk in with that and you open up a lot more options and a lot more lenders. Under the current rules, that 10% injection is mandatory in 2026. I'm gonna keep saying the year because you never know what might change in the future. The near 0% down window, where buyers were able to lean almost entirely on seller financing, is closed. It's done. A seller note only counts towards your required injection if it's on standby for the entire life of the loan for most SBA approved lenders. That means the seller gets no payments at all while your SBA loan is outstanding. And even then, it can only cover up to half of that injection. In plain English, you, the buyer, generally need to bring at least 5% real verifiable cash that you did not borrow. But the number of lenders that allow you to do that with such a low down payment in 2026 is very slim. On the rest of the terms, these loans go up to $5 million. A business-only acquisition, where you're buying the operation, the goodwill, and the equipment, typically amortizes over 10 years. If there's commercial real estate in the deal, that piece can stretch way out, often up to 25 years, which brings your blended payment down a lot because of the longer term. Rates are variable for this program, but it's tied to the prime rate, the Wall Street Journal prime rate, plus a lender spread that the SBA caps. So your payment is predictable enough to actually build a business around, and that long term keeps it very manageable. Now here's the part everybody gets backwards, so listen closely. When you apply to buy a business, the lender is not looking at you first. They're looking at the asset that you're buying, the business. and then they're looking at you second. Now, let's get into detail about the first thing lenders look at. Number one, does the business cash flow? This is the heart of it. The numbers that decide this are called DSCR, which stands for debt service coverage ratio. Don't let the term scare you, because the idea is super simple. It's a measure of whether the business throws off enough cash to comfortably cover the new loan payment with the cushion on top. Lenders generally want to see a DSCR of at least 1.25 on the deal. Now let me break that down, because 1.25 DSCR means nothing until you see it in dollars. Say you're buying a business and your SBA loan payment comes out to roughly $150,000 a year. 150 divided by 12, that's your payment. A 1.25 DSCR means the lender needs to see the business generating at least about $187,500 a year in cash flow available to make those payments. That's your $150,000 payment plus a 25% cushion of net profit on top of it. That cushion is the point of all of this. The lender wants room for a slow month, not a business that barely scrapes the payment together. So if that business only nets $120,000 a year, the deal doesn't pencil. The cash flow can't even cover the payment, let alone the cushion, and the lender passes. Maybe the person that you're buying the business off of needs to lower their price. But if the DSCR is throwing off north of $200,000, now you're in great shape. The cash flow of the business sets the ceiling on what you can and what you should pay for it. And here's one more thing the pros know. The lender doesn't just take the bottom line off the tax return. They calculate the business's true cash flow by adding back things like the current owner's salary, depreciation, interest, and any one-time expenses. That add-back number is the real earning power of the business, and that's what gets measured against your loan payment. A good deal often looks more profitable after the add-backs than it does on the surface of the tax return. And knowing how to find that number is a big part of the game. So remember, the owner's salary, the depreciation, and the interest. Just three of the things that normally get added back into your tax returns to show true cash flow and profitability. And it's not just the raw cash flow. The industry of the business you're buying matters too. A business in a stable, predictable industry with recurring revenue is an easier yes than one in a volatile or seasonal space, even at the same cash flow. Lenders have opinions. If one lender favors a certain industry, it may be because they've seen a lot of gains in that industry. If one lender does not favor a specific industry, it may be because they have seen a lot of losses in that industry in the past. So you really need to understand the lending landscape in order to figure out which lender is going to be the best fit for your industry and your credit box. And that's exactly what we do at Small Biz Heroes. We have relationships with hundreds of lenders across the United States and some in Canada, and we understand which industries they all prefer and which ones they don't. Because the business comes first, so do its documents. And it's common misconception that borrowers can get pre-approved before the documents and the cash flow is even underwritten. So if a seller tells you, the buyer, to get a pre-approval for an SBA loan for their business, tell them straight up, listen, how am I supposed to do that? Any lender out there is going to want to see your financials to see whether or not I can be approved for this business. Because before they ever really dig into you, the buyer, this is what the lender wants on the company you're buying. The last 3 years of business tax returns, the most recent year-end financials, a current interim year-to-date profit and loss and balance sheet for the business that you're buying. That small package is the upfront package that proves the cash flow is real and current. And if the seller can't produce it or the numbers don't hold up under a real look, the deal stalls right there, no matter how strong you are as a buyer. So remember, cash flow is king. And if you're shopping for a business, you want to ask yourself this stuff early, because it tells you fast whether you've got a real financeable deal or just a story. The second thing lenders look at is you, the buyer. They want relevant management or industry experience to some extent, depending on the industry. They'll look at your personal credit too. There's no single magic number here, but most lenders want to see you at least in the high 600s or better. And as of last year, you 100% need to be a US citizen or a lawful permanent resident to qualify for an SBA loan anywhere. And last but not least, you need that documented cash for your injection, the liquidity. And don't forget about that extra liquidity sitting behind it that the majority of good lenders want to see now too. That's the order, guys. Business first, buyer second. Get that straight and the whole process makes a lot more sense. Now I'm going to talk about the process from start to finish. This is how a deal like this actually comes together, so you know what you're walking into. It starts with finding the right business and agreeing on a price and a structure with the seller, usually written up in an LOI or letter of intent. Most of these deals get structured as asset purchases, and seller financing is quite common. Honestly, it's often a good sign. A seller willing to carry a note is a seller who believes the business is going to keep performing after they're gone. From there, you go to an SBA approved lender. And listen, which lender you pick matters enormously. I can't stress this enough. Two buyers with identical profiles buying two businesses with identical cash flow can still get completely different answers from two different lenders. Each one layers its own standards on top of the SBA's, and each one has its own appetite for your industry. Because remember, the SBA isn't lending any money. They're only guaranteeing up to a certain percentage of the money that the SBA approved lender is putting out there on the street. So the right lender for your specific deal in your specific industry is a big part of the battle. Then comes underwriting and due diligence. The lender digs into the books of the business you're buying. That package of tax returns and financials we just talked about, they order an independent business valuation, so you don't overpay on their dime. And they verify the cash flow holds up. You'll also hand over your personal financials, your background, and proof of your equity injection or liquidity. Expect it to take longer than a normal loan, usually a couple of months, and expect heavier paperwork as well. But remember what you're getting on the other side. You get to buy an entire profitable business for a fraction down. The extra diligence is the price of that leverage, and it's worth it. Now, probably the most important part of the video, the mistakes that kill these deals. If you agree to a price that cash flow won't support, the DSCR falls apart and the deal dies. But there's good news here as well. And it's one of the most underrated things about SBA financing, in my humble opinion. An SBA deal will only make it over the finish line if the business you're buying is profitable enough to support the payment. So the approval itself is a safety check. The SBA process quietly protects you from overpaying for a dud or a lemon. Let the numbers set the price, not your excitement, not emotions. And let the underwriting be your second opinion. Mistake number 2, buying a business with messy books. If the seller can't document the cash flow they keep bragging about when trying to sell you their business, the lender can't underwrite it. And let's be real, a seller who does a lot of business in cash off the books is a red flag to a buyer, because that invisible money can't be financed. The cleaner and the more documented the numbers are, the smoother your deal goes. Mistake number 3, underestimating the cash that you need. Bring real, traceable cash to the table. And don't assume seller financing erases your down payment, because it doesn't. And remember, 10% down with roughly 10% liquid behind it is what really opens the doors. Buyers who show up short on verified equity or who'd be tapping out the day after closing usually get stopped cold. 4th mistake, no industry experience and no plan for it. If you've never been anywhere near the industry you're buying into, lenders get nervous. Have an answer for that, a background that translates, a key employee who's staying on, or a real transition plan with the seller themselves. Mistake number 5, rushing the lender pick. Going with the first bank that picks up the phone instead of one that actually knows acquisition loans and likes your industry specifically is how good deals get bogged down or flat out declined. So here's the truth about buying a business with an SBA loan in 2026. It's one of the most powerful moves you can make. You're buying proven cash flow for around 10% down. But the rules tightened. The business's cash flow has to carry the deal, and the lender you choose can make or break it. And this is exactly what we help with at Small Biz Heroes. If you've got a business you're thinking about buying, or you just want to know what you qualify for before you go hunting for that business, let us walk through it with you. We'll run the cash flow and the DSCR the way that a lender will, pressure test the deal, and match you to the right SBA approved lender for your specific industry. And I'll tell you honestly whether the deal pencils out or whether it needs some work before anybody funds it. A call with us is completely free. Call us at 888-859-8408 or click the link below. And if you want the foundation under all this, go watch my video on how the SBA 7A loan works. There's a bunch of them on this channel. And make sure to subscribe so you don't miss the next one. And as always, I'm rooting for you.